Good morning from London. I'm Anna Edwards alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. Jerome Powell takes centre stage at Jackson Hole later today. Markets are hoping for signals about a rate cut next month, but could a focus on inflation targeting sound hawkish? Nvidia orders suppliers to halt production on its China-focused H20 chip. That's according to a report after Beijing ordered local companies to avoid the product. Plus, the EU and US outline plans that could cut tariffs on European cars, but lower tariffs on the drinks sector remain elusive.
OK, let's talk about this market. Equity markets are like deer in headlights this morning. This Friday, going into Jackson Hole, Euro Stoxx 50 futures, S&P futures, nothing to see here. We're a little softer, but not by much. The action is elsewhere. The Chinese market love that H20 story that we just heard from Anna. Looks like local producers will get a leg up. Tech stocks have rallied in Asia. The CSI 300 is up by 1.64%. So that's one story that we can fold into the markets this morning. The dollar's definitely on the front foot going into Powell. You can see that. But I have to say the Japanese inflation print is something to focus on. Ueda is going to speak tomorrow, Saturday. I think that's going to be really interesting as well. It's not just Powell in focus. It is some of the other central bankers as well. But Powell, obviously, the main event of the day. The countdown to the opening trade starts right now. Morning, folks. Friday the 22nd, the day we've all been waiting for. Powell is going to speak at 3 p.m. London time. We are 8 hours away from that speech. The countdown is definitely on right now. Expectations have been growing throughout the week. You've seen it kind of ebbing and flowing around whether or not he is going to be dovish. But the latest tone appears to be maybe less dovish. And that's going to potentially provide some volatility later on.
Absolutely, that could provide volatility because we've seen the markets quite preoccupied by this question, certainly all week, about whether we're going to get any clues about September, about a potential rate cut in September from Powell today. But as you say, some of the latest clues, whether you look at the data, the PMI coming in strong, or you look at the commentary from Fed officials, not all suddenly declaring that a rate cut is required, or whether you look at some of the expectations about what Powell is really going to be talking about, which is inflation targeting. All of that adds up to something that could be a little more hawkish than the market was maybe anticipating.
If he's not dovish, he's hawkish, seems to be the expectation. That seems to be the kind of the line that we're looking at here. And a more technical speech on what exactly the structure of the framework looks like maybe delivers exactly that. And I think that's going to be interesting. And the commentary from some of the other Fed speakers going into this as well appears to be less dovish. The market definitely got into the more dovish camp at the beginning of the week. We've faded that ever since, but you do wonder whether there's still, as I say, significant volatility to come.
And that PMI, the manufacturing PMI data that came in yesterday, the market, we were talking about this with Valerie before the programme, the market seemed to really jump on that, despite the fact it doesn't support the market's view. It was a strong set of data, and strong data was seen as bad news for stocks. We saw stocks retreating. So the market is prepared to listen to those kind of arguments, prepared to perhaps tune into that kind of message if we get from Powell some pushback against September cut expectations.
Well, that's where the pain point is, isn't it?
Yeah.
Like stronger data.
Short-end yields could be see some pain as a result.
It's going to be interesting, some of the other central banks. I just want to flag these as well. I think Ueda is going to be interesting. I think the Japanese story is going to be certainly something you want to watch. I think the data today speaks to the idea that maybe actually Japanese inflation is a little toppy, and we are going to get a response. And I wonder whether Ueda is going to set that up. Lagarde, I'm not convinced, is going to be as interesting, but I think Ueda will be interesting. I think the Bank of England's also worth paying attention to as well. Bailey's going to be speaking. He's got a real dilemma, I think, to deal with in the UK, and I wonder whether we'll get some clarity around that as well.
And this runs into the weekend, doesn't it? We should point that out. This goes on until Saturday. So, the central banking fun continues. Meanwhile, we need to focus on AI and tech news then.
So I was just flanking what was happening with the Chinese stock market today. The Chinese stock markets have done well. Chips have led that. The tech story's been front and centre. The reason for that is apparently Nvidia is halting production, or has asked its manufacturers, the fabs, to stop H20 production. The Chinese have been pushing back very firmly on this. We were talking to Tom about this a little bit earlier on as well. He was flagging the Lutnick comments a few days back, which seemed to have been the catalyst for this kind of more abrupt shift from the Chinese authorities. He was saying, you're getting the fourth worst product out there, or the fourth best product, I guess is maybe the way of looking at it. The Chinese really took offence to that. The regulators have really taken offence to that, and they've pushed back. They want Huawei to have more demand for its chips. They want to push that story forward. They want to be domestically focused, and this is the narrative. So can Nvidia kind of circle back round again with a better chip
Yes.
for the Chinese that they would accept? And would that be something that maybe lifts the narrative around Nvidia? Because we're going into earnings next week, and that's one of the key risk events for next week.
It is absolutely going to be one of quite a few. You know, there aren't that many big events next week, so it's going to get even more focus than it would normally. But Nvidia will be a big focus for us next week. When I first saw these headlines, they were stopping H20 or putting pressure on, or asking, as you say, suppliers to stop H20 production. I thought, is this a positive? Because they've been wanting to move towards a more powerful chip for China. They need to get approval from the White House for that, but it doesn't seem to be that that's the motivation here. It seems to be, as you point out, the pressure from the Chinese on Chinese companies to not buy this product, because the Chinese fear that there are backdoors in here and location technology. Jensen Huang's been out in the media in Taiwan pushing back against that and suggesting that the technology doesn't have any of those things. But this does seem to be a negative. But worth pointing out in that context, though, that US futures are, you know, Nasdaq futures down 0.2%, which is worse than they were an hour or so ago. But that's not a massive tech sell-off. Waiting for Jackson Hole, perhaps still.
No, you see, I think precisely. I think you're right. We're waiting to see what happens with Jackson Hole. It is going to be. You do wonder how the White House is going to respond to this, in as much as chip exports to China were meant to be a revenue-generating story as well. So you do wonder whether there's more latitude.
Maybe China doesn't like that.
Maybe as well. And the whole idea is that the Chinese become addicted to US tech, and the Chinese definitely don't like that. Talking of transatlantic trade, let's talk about what's happening with the EU. The deal's kind of done, but not done.
Yeah, absolutely. And this is the new world we're in, isn't it? Where trade deals are entirely done and not done, all at the same time, all at once. So yes, we've had the fanfare around the 15% deal for Europe, but so many questions were left around specific sectors, and the auto sector is one of them. And so we've got more details now about how some of these sectors are going to be accounted for, in particular those that were vulnerable to sectoral tariffs. The auto sector already has a sectoral tariff, but the details on cars are quite interesting. Yes, they might get a lower tariff on cars, this is Europe, but this is reliant on some specifics around industrial policy and seafood policy that Europe has yet to introduce. And until those things are introduced, then the Americans won't give the lower tariff. So this is what I mean about, you know, we're perpetually in tariff negotiations.
It feels a lot more like Brexit. If we're back to seafood and fishing and those kinds of things, it feels like there's definitely sort of a Brexit echo in all of this. And we still don't know. The pharma story has been partially done. There could be huge pharma tariffs coming, pharmaceutical tariffs here. I need to be specific. We're not talking about fish farming. We're talking about the drugs. And it'll be interesting to see how that story develops. We still don't have a carve-out when it comes to wines and spirits. That is still being hoped for. That doesn't look like it's going to happen anytime soon. There's a lot of work still to do here.
Yes.
And to your point about the perpetual kind of uncertainty, how big an impediment is that going to be? Are we going to start to see it showing up in the data? We haven't yet. It feels like we may, though, still see that. Because if you just don't know 1 week to the next, day to day, minute to minute, what's going to happen, how do you plan?
Yeah, it's a rolling process. And whilst many governments traditionally might have been very alert to the idea, aware of the idea that businesses price certainty, you know, we've got a US administration that has a policy agenda it wants to enact. And if that means some uncertainty for business, it seems as if they're quite comfortable with living with that. Plenty then to talk about with our guests today. Let's tell you who's coming up on the programme. Paul Skinner, Wellington Asset Management Investment Director, a focus on fixed income there, and that'll be interesting, thinking about the vulnerability, particularly at the short end of the curve then, as we head into Jackson Hole. Then what does the dollar make of Jackson Hole? Sonja Marten will be with us, DZ Bank Head of FX and Monetary Policy Research, so plenty to talk to Sonja about, again, ahead of Jackson Hole. Salman Ahmed will be with us from Fidelity, Global Head of Macro and Strategic Asset Allocation. Maria Demertzis, the Conference Board Economy Strategy and Finance Centre Europe leader, will be with us to talk about the European economy. And I hope we still have time to talk about travel. I think that's the plan, it being Friday at the end of the programme.
So next week feels like peak summer. The US is off. The US is off the following Monday. We're off this Monday. We're not going to be. We will have a show. Tune in. It's going to be great. But it feels like we're kind of in that. So it feels like a perfect moment, maybe, to talk about what is happening this summer. Wildfires, heat, over-tourism, all of that folding into that narrative. Let's talk about what else you need to know this Friday morning. Bloomberg understands that Meta is hiring another key AI executive from Apple, even as the social networking company prepares to slow its recruitment. We talked yesterday about a hiring freeze. We're told that Frank Chu, who led Apple's AI teams focused on cloud infrastructure, training and search, will be joining Meta's superintelligence labs. Chu follows several of his colleagues to Meta, which also hired the heads of Apple's AI models team recently. Staying in the AI space, Anthropic is nearing a deal to raise as much as $10 billion in a new round of funding. Sources tell us the fundraising is bigger than expected and one of the largest mega rounds to date for an artificial startup. Bloomberg has previously reported that Anthropic was in advanced discussions to raise up to $5 billion in the round at a valuation of $170 billion. So we've significantly stepped that up. And Bloomberg has also learned that the Trump administration will not seek equity stakes in chip makers like Taiwan Semi and Micron that are boosting their U.S. investments. Micron has pledged $200 billion, while TSMC has pledged to invest an additional $100 billion in the United States. The comments come as the Trump administration is working on a deal that could see the U.S. government taking a 10% stake in Intel.
Coming up on the programme, it's summer and many vacationers are avoiding traditional holiday spots, we are told. We will talk about the latest trends with an industry expert. Where are the new places to put on your radar in terms of travel destinations? Plus, German households are buying stocks, finally digging into their savings, apparently. We will discuss the reasons for this new phenomenon. And up next on the programme, Jackson Hole is, of course, in focus, with markets hoping that Jay Powell will signal cuts next month. Will they get what they want? Will they be disappointed? We'll have plenty of views and opinions on that front. If you have questions for our guests, if you want to get involved in any of these conversations ahead of Jackson Hole, IB plus BBTV Go, that is the function to use on the Bloomberg terminal. This is Bloomberg.
Today, Bloomberg is live at the Jackson Hole Economic Symposium, bringing you news and interviews with Fed leaders and other economic experts. Tune in for a special episode of Surveillance at 9 a.m. only on Bloomberg.
The last inflation report that came in, where you saw services inflation, which is probably not driven by the tariffs, really start shooting up, is a danger. That's a dangerous data point. I'm hoping that that's a bit of a blip. So I think we still have a fair bit of information that we're going to get before September or the whole fall to determine what path we're going to be on.
Some data dependence, perhaps, from Chicago Fed President Austin Goolsbee there, speaking from Jackson Hole, of course. Let's bring in Bloomberg's Valerie Teitel, who's been listening to all this Fed commentary, Val, and putting it all together for us. So what do you conclude, Val?
Well, look, I'm reading the tea leaves here. Yes, we did hear from a lot of hawks yesterday, but no one is penciling in a September cut as a done deal. We heard from various Fed members. A few of them all mentioned that given the current stance of data, they don't see that September cut as warranted. We heard that directly from Fed's Hammock. We also heard it very much implied from Fed's Schmid as well. We also heard from Bostic, him saying that he is still penciling in one cut for the remainder of the year. So it doesn't seem to be that there is any dovish narrative that is amping up into Jerome Powell's speech, but maybe they're all waiting to hear the big signal from the guy himself later this afternoon. But we have seen a rise in front-end yields that was very much the focus of yesterday's session. Yes, we had a rise in jobless claims. That's another negative for the labor market, but the PMIs came in strong, and that's what's really led the sell-off, as well as that hawkish language from Federal Reserve members. We have now been paring these September rate cut odds back after hitting over 100% last week. Ever since that hot PPI, every day they seem to be ticking down. We're now standing at a 75% chance of that rate cut come September, with a lot of data still between Powell's discussion today and the Fed's decision on September 17th. But this kind of hawkish positioning is leading the equity market to fall from those all-time highs. We're now down for 5 straight sessions in a row for the S&P 500 index. S&P futures in the last 6 sessions down near 1.7%.
Val, the Nick Timmer's, not the Nick Timmer's speech, the piece, speech, got speeches and pieces. The journal piece this morning, I think it is Timmer's actually, talking about the fact that this is going to be a technical speech. That he's going to talk about the framework and the framework that was put in place a few years ago, and they're going to reverse that and go back to the kind of pre-pandemic framework. If that's the speech, is that hawkish?
In my mind, yes, that is hawkish, right? We need some evidence from Powell that he has changed his tune on the labor market. If we don't get that today, I think the front end is vulnerable to a sell-off. But as you mentioned, Nick Timrose in the Wall Street Journal talking about the potential axing of the flexible inflation targeting. That's something that our own Anna Wong has written about as well. This was a tool that was really helpful for the Fed back in 2020 to look through the initial rise in inflation. It's not so helpful now that we have inflation running above target for so long. But if he wanted to sound neutral, Guy, he could do what other Fed members have done recently, which is just stress data dependence, that we still don't know what the outlook for that September meeting is because we have another CPI print, another labor market print to go, and he needs to see some sort of evidence that the labor market is continuing to weaken and inflation is continuing to fall.
So come back to the point, the idea that the Fed's interesting, but the response in the White House is more interesting. And you do wonder how much political pressure could be piled upon the Fed if he is in any way hawkish or even maybe neutral today. Valerie, thank you very much indeed. Joining us now, Paul Skinner, to talk about all of this, Investment Director at Wellington Management. Good morning.
Morning, Guy. Good to see you.
If he's not dovish, is he hawkish? That seems to be the feeling going in. At the beginning of this week, everybody thought he was going to be dovish. The market, the front end moved. The expectation was that we were going to see a pivot. Back end of the week, going into the speech, what are we, 7.5 hours to go? Doesn't feel like that now.
I think it's a really exciting day. And I think it's a day that we're going to look back on and say, this is when the market narrative changed.
Wow, okay.
That's like last year then. Yeah, I mean, that's like last year's
Jackson Hole tends to deliver. I mean, over the years it's delivered. But I really...
To what?
Well, we do believe that he's going to be quite hawkish, or he's certainly not dovish. And that's a material, factor that markets haven't got discounted into them. And I think this is symptomatic of central banks around the world. Yeah. We're going to be changing the discussion. Now, we just look at what Powell has in front of him. He's got clearly all the things he warned about in July coming to fruition. When we look at the underlying data in inflation in goods, we're seeing apparel, zero inflation beginning of the year, now up 3%. Household goods was 2%, now up 5%. Electronic goods was zero, now up 2%.
But services where the problem is.
And it's high.
That's what Austin was talking
inflation
about.
Is high there.
Yeah.
And so what we see is, as we go through to the end of the year, PCE at 3%, headline at 3.5%. This is, and he's going to have data looking forward as well. Okay. We saw, but in the PMIs, we also saw, hiring intentions increasing up to a level.
What's mispriced off that scenario? If this is the pivot, what's mispriced going into the new paradigm that we're going to, the front end of the curve, obviously, but what else?
The short end has got to pivot up, and basically risk assets are incorrectly priced. We have really full valuation.
By how much? By a lot or by a little?
By a substantial amount of volatility. And I think this is the key. We've got a paradigm here that we actually think that, economies are actually rather good. And that's going to be the problem that faces central banks. So that paradox is that risk assets are going to look at a long-term good scenario, i.e. economies are coming, but short-term we have to have a rethink about the direction of interest rates.
So you think hawkish then, Paul? Is that hawkishness going to be overt, or do you think it'll be hidden behind quite a technical conversation about average inflation targeting and all of that stuff that Guy was just asking Valerie about, that a lot of people have focused on ahead of this Jackson Hole speech?
That's why we're getting these leaks. We're being gently informed that this is certainly not going to be dovish. It's going to switch to some technical things. But I think within the speech, he's going to be weaving in the fact that he has inflation problem. He's got a story on labour that, as we all know, has signs of slowing demand, but also that supply story is slowing because of migration. I know you've all discussed this many times, but also because of exactly the subject they're talking about at Jackson Hole, demographics. That, in our belief at Wellington, demographics are a secular driver for higher, stickier inflation. Yeah. And that's the issue he's going to be talking about.
OK, so this isn't an inflation problem that's only about tariffs then. You think this is just a sort of a more widespread, we're in a higher inflation environment than we were post-GFC, and we haven't quite got our heads around that.
Correct. And I would broaden that into the global economy. I think, the global economy looks in good stead. there is, a good sign that we're going to see that economy pick up steam. Why? Well, real rates are basically zero. We've got fiscal stimulus around the world. But the problem is we've got 40-year lows in unemployment in developed markets. We've got inflation that came down and plateaued at 3%. Those are all issues that central banks around the world now have to think about. And this is what I mean about changing the narrative. I think that markets are no longer going to have to or look at declining rates.
Yes.
They're going to look at rates that are potentially flat. And
OK, which is why it's interesting. I think in your notes I picked up on the fact you said that even a Trump-appointed chair will struggle to cut rates. And that makes more sense to me now after what you've said there. It's because you think we're in a higher inflation world.
We speak about being data dependent, and I think that data is going to be punishing on the inflation side, and also that labour squeeze where you end up with demand and supply both low but matched, and therefore you have unemployment at 4.2%, which is below the inflationary rate.
What happens if the next chair, though, does cut rates aggressively, as the president would like?
We've already seen.
How big a move do we get at the back end?
Well, that's going to be painful because we've already seen the market discount that. We've got 5s to 30s, 100 basis points in most countries at the moment, and I think that's the warning sign that the market's onto this story, and you could see another 50 pretty rapidly if people feel that the Fed is being controlled and doing irresponsible things. So 50 to 100.
What do I do here? So coming into the week, I've got the VIX at 14, starting with the 14 handle. The move index is low. Volatility in the bond market's pretty low as well. Do I want to get long vol here? Is that the trade going into this? So
that is the story that we feel is going to evolve over the next few months. A long vol trade. There's going to be volatility. Now, Wellington.
But a flattener or a steepener?
A bear flattener.
You think it? Okay.
Bear flattener for the time being, and then we find out what the quality of the new Fed will look like as we go into next year, and that will determine whether that back end loosens up and sells off again. But a bear flattener as the short end comes up, flattens out the curve a bit, and then we wait and we watch. Now, the thing you're going to see is volatility in risk assets. Now that presents opportunities. Wellington, we're active managers. There are going to be some fantastic...
Where are they? Where are you looking now?
Well, first and foremost, you've got to look at things that are inflation sensitive and, dial back what you're worried about. Also, that long-term, rate is going to be that much higher. So over-leveraged companies, you've got to start worrying about. There's been a sort of, in credit markets, all boats have been floating, regardless how good or bad they are. We're going to see some discovery. We're going to see dispersion. We're going to see the over-leveraged companies be discovered and, rooted out. So, yes, there's going to be some variability, dispersion in how both countries perform and
companies.
Individual companies.
And just briefly then, if we're looking for inflation protection, in terms of sectors, are we going back into commodities more? I
think the commodity story is going to run and run, absolutely. And because the whole, the thesis behind here is sticky high inflation, but with an economy that's running quite comfortably behind it. And I think, the poster child for a central bank that's not been quite creating the slack required by economy is the Bank of England, and we saw that revealed when they had their split vote. And there are some big views within that central bank, and the narrative has been that don't worry, low growth and tight fiscal policy is going to get inflation down. It simply hasn't worked. Last year, they thought inflation was going to be about 2.1% by now. It's double that. It's 4%. So you've got an economy in the UK where you've got services inflation at 5%, wage inflation at 5%. You've got a growth at about 2%, which is 1% over trend. That's an economy. You shouldn't be cutting rates. You should be raising rates. And that's the discussion we're going to be having as we head to the will the Bank of England raise rates?
OK, Paul, thank you very much. Paul Skinner, Investment Director at Wellington Management. A lot to think about then as we head towards Jackson Hole and the wider inflation narrative globally. Will Jerome Powell then signal September rate cuts, or will, as we were just talking about, be more hawkish? We'll get into an FX conversation next. This is Bloomberg. Welcome back. This is the opening trade. It is Friday morning, 30 minutes until the start of trade, though. We still have one day to go. We still have a Jackson Hole speech looming on the horizon. 3 p.m. UK time, we hear from the Fed chair. Futures, then, with that in mind, showing a little bit of movement, but not much, down by 1/10% or so on Eurostoxx 50 futures. US futures also being influenced by that report guide from The Information, talking about whether Nvidia has asked its suppliers to stop production of the H20 chips. NASDAQ futures over in the United States down by 0.2%.
Everything's calm in the equity market, waiting for Jackson Hole. We'll see what happens a little bit later on. We have got 7.5 hours until that speech from Jay Powell. Treasuries are absolutely becalmed as well. Nothing to see there. 4.3% on the US 10-year. EGBs, European government bonds. Big day yesterday on the back of the PMIs. Today, a little bit of a move higher in yields, but not by much, I have to say. So, again, maybe waiting, watching, trying to sort of discern what we're going to get out of Powell, because that will obviously have a transatlantic effect. One thing I will flag is that the back end of the Japanese bond market is worth paying attention to. Inflation is a factor in Japan. We're going to hear from Ueda tomorrow as well at Jackson Hole. Japan's 30-year yield hitting fresh record highs. That bond was debuted in 1999, which was an interesting time to debut a bond, going into obviously 2000. But we have now hit a record high on yields as inflation continues to be an issue for Ueda.
Yes, absolutely. So long end in focus for those reasons globally. The short end in focus in bond markets then, because of what we might hear from Jackson Hole. Bond investors are heading into today's much anticipated Jerome Powell speech, looking for any clues as to what policymakers intend to do next month when we get to the September Federal Reserve meeting. Joining us now is Sonja Marten, Head of FX and Monetary Policy Research at DZ Bank. Sonja, thank you so much for being with us. So at the beginning of this week, lots of the conversation was all about what clues would we get around a rate cut from Jerome Powell? As we've gone through the week, we've got more positive data. We've got not necessarily dovish commentary from Fed officials. And now we've got clues that perhaps there'll be some hawkish lines around inflation targeting from the Fed. So does that add up to something more hawkish? What are you expecting from Jerome Powell?
Well, I mean, the Fed is sort of stuck between a rock and a hard place. As you said, I mean, there is sort of conflicting evidence looking at the labor market and the inflation front. I mean, inflation has ticked higher, maybe not as much as people had feared, but it's definitely on the move up. We had some weak data from the labor market. So, the Fed, I think, does definitely have room to cut rates further this year. And that is, I think, the message that Powell will send. However, I mean, we have to keep in mind that quite recently people had started discussing a very aggressive path for the Fed. And I think that's something he's not going to open the door for, partially because I think fundamentally there's no reason to. And also, he's got to really make sure here that in terms of the way that he communicates with the market, he makes it very clear that he would not be pressured by the White House to go down a path that might not be fundamentally justified. So I think 24 basis points, next cut, September, that door is going to be open. But I don't think he's going to be more aggressive than that. So very data dependent, I think, at this point.
So data dependent, perhaps. Is that going to be the message he wants everyone to take away? So no commitment either way? Or will he talk about ending flexible average inflation targeting? That's a bit of a mouthful. Will he talk about ending that with a view to trying to deliver a slightly more hawkish message? Because you can interpret that policy change as slightly hawkish.
Well, I mean, Jackson Hole has always been good for some surprises. I mean, we have seen that in the past, so I wouldn't rule it out. But I think I don't think he's going to be as aggressive as that. I think there's no point in sort of poking the bear in the White House. So I think, a sort of cautious, slightly dovish, data dependency. I think that's the smart way for him to go, unless, of course, he does want to go into open confrontation with Trump, which, may happen. But it's not our base case scenario.
That sounds like it's slightly hawkish at the edges. If he's not dovish, he's being hawkish. Do I want to be long the dollar, Sonja, going into today?
Yes, I think there's a risk here because we have seen Eurodollar, sort of struggling to make a headway up north. We had sort of seen lower highs developing over the past week or two. So there is a lack of dynamic. I do think that, the dollar has there's some potential for correction. When you look at the speculative market, there's a massive overhang here still of long Eurodollar positions. And it worries me slightly because I do think there's a risk that if we do see a correction lower, maybe as a result of today's speech, then that can, of course, accelerate as these positions get closed. People sort of give up hope that we're going to see 120 soon. So there's a risk, I think, that we're going to see more of a correction and possibly, yes, as a result of today's speech.
Is that correction going to be a buying opportunity? Is the longer-term trend dollar negative? If we see a Fed chair that comes in next year that is overly dovish as a result of White House policy, would that be dollar negative? Is this going to be an opportunity that's created here effectively to buy the dip?
Yeah, absolutely. I would absolutely underline that. I do think if we see a bigger correction low, that is going to be an opportunity to come in to build fresh long positions. I mean, the dollar is fundamentally damaged. You know, we have seen, you know, a lot of things have happened this year that we never would have believed possible before. And, you know, with the Fed heading next year definitely into a very dovish direction, I do think that the dollar is on a downward trajectory in the medium term. I would say, though, that we shouldn't forget the other side of that coin. I mean, it's easy to be bearish on the US dollar. I mean, there's plenty of reasons to. It is a little bit more difficult maybe to make a strong case for a strong euro, given, you know, the situation here is difficult still. So, you know, I think one shouldn't get, you know, too excited about levels, you know, massively above 120. But I think, yes, buying opportunities absolutely on the dips.
And what is it about the euro story, Sonja, that remains a little unconvincing right now? Is it that we're just going to get more cuts from the ECB at some point because tariffs are going to take their toll and the economy is going to struggle a little bit more, or is it not that and it's something else that's going to weigh on the euro?
Well, I mean, when you think about what happened this year, I mean, the euro has been performing really well, not just against the dollar all year round. I mean, we have seen a really strong performance, and that's sort of based on hopes for growth in 2026. You know, this is where fiscal policy in Germany particularly comes in. Then the realization that the ECB will end its rate cutting cycle, you know, very soon or has already ended it. And so that's all driven the euro higher. And of course, we had a market that was massively short euro in the beginning of the year, was caught completely on the wrong foot. So we had position adjusting, building of fresh longs, all that's driven the euro. But all of these factors, you know, I think are pretty stretched at this point. So, you know, we would need some massive positive surprise from the European economy to justify, just on the euro's own steam, more advances higher. And so I think we're going to now depend much more on what's happening in the US. So I think it's more of a dollar story now than it is a euro story.
OK, so we keep watching the dollar, of course. In terms of flows and how people are positioning here, then, Sonja, our last guest was saying that money is going from the US into Europe and Japan. But you say that you see foreign investors still piling into the United States. Maybe you're looking at different data sets, different asset classes. But what is the story there?
Well, I mean, we have heard quite a lot of anecdotal evidence throughout the year of investors looking to leave the U.S., go elsewhere, diversify more actively. And the latter, I'm sure, has happened. But when you look at the U.S. portfolio flow data, and we've just got the numbers for June, you know, the first half of the year, foreign investments in long-term U.S. dollar assets amounted to $800 billion. That's 70% of the flow we had the entire of last year. Strong demand still for U.S. treasuries, U.S. equities in particular as well. So, I mean, of course, one could argue that it would have otherwise been more, but the fact of the matter is that demand for U.S. assets remains strong, and we've long said that the reason for this is not just that people are particularly bullish on the U.S. I think part of the reason is always going to be the lack of real alternatives if you're looking at the really big flows. I mean, the German bond market is like it was a tenth of the U.S. market, so I mean, there's a limit to how much you can diversify.
Sonja, do you think the BOJ is going to have to raise rates? Are we going to get hints from that from Ueda this weekend? What does that mean for the yen in terms of policy going forward? How far does this policy hiking cycle ultimately go?
Well, I mean, there's definitely room and the need, I think, for rate cuts from the BOJ. I mean, certainly the level of interest rates is much too low at this point. 1% ultimately seems a much more sensible level to get to, maybe. And we're definitely big fans of the yen. I mean, with the shift in monetary policy in Japan and everything that's happening, we do favor the yen. I mean, we have a dollar-yen forecast on 12 months of 135. So we definitely think that the yen is going to be one of the currencies to watch over the next 12 months.
Great to catch up, Sonja. Have a great weekend. Thank you very much indeed. Sonja Marten, Head of FX and Monetary Policy Research, joining us from DZ Bank. Coming up, we're going to be tracking wind stocks today. This after the Trump administration launches an investigation into imported wind turbines. We're going to talk about that and all the other stocks you need to be watching this Friday morning into Jackson Hole. This is Bloomberg. Just over 7 hours until the Jackson Hole speech delivered by Fed Chair Jay Powell. We're all on tenterhooks waiting to hear what is going to be said. Hawkish, dovish could mean a lot to the market a little bit later on. This is how futures are positioned going into that. Not a lot of movement, a little downside in the DAX. There's a few upgrades, actually, that could affect the DAX this morning. The CAC, though, down 0.2% as well. The FTSE 100, after a fairly good run, actually, recently, absolutely flat as a pancake going into the Friday session. Let's talk about what we have heard, though, going into the Powell speech and kind of how that sets the tone and expectations. Kansas City Fed President Jeffrey Schmidt says American businesses are showing renewed optimism. That's filtering through to the labour market and putting the focus back on inflation. Schmidt spoke with us from Jackson Hole about the economy and, of course, the growing political pressure that is hitting the Fed.
I'm a little philosophical about the whole conversation of Fed independence and where our role is in the American economy. We're almost 250 years old as a nation. I think there's something to be said. We were built on words, and we continue to debate those words legislatively and judicially. Whatever friction we might have with other branches of the government, I think great steel's tested by fire. So we can always be better. We can always do this better. But I think the nature of independence, and I think, don't believe me, believe other nations that have central banks and don't. It seems to work, but I'm always open for the conversation of how do we make it better.
Well, the big question for everybody, especially for Wall Street, is what happens on September 17th?
So this is, as you know, kind of an interesting month because we've got Jackson Hole and then we've got quite a few weeks of data to kind of pull in. So I'm really, I think everybody's quite interested in some of the maybe the prints that happened in the last couple months and kind of where they go from here. So I'm like everybody. I think there was some fascinating conversations at the last FOMC. As you know, there were a couple of dissents. I think my interpretation of what's happening, especially in the labor market, is that the first couple quarters, a lot of business people were just saying there's uncertainty enough, and I think they kind of cooled a little bit on the higher side. But the most recent couple weeks that we've been talking to businesses in the district, there seems to be a burgeoning optimism again, that they've kind of digested and they've been agile enough to try to work their way through some of the new policies from the administration, and maybe going forward, maybe we'll see a little bit of uptick. That said, I still believe that the inflation number is trending closer to 3 than 2.
Well, we saw that in the minutes that, in general, the Open Market Committee felt that inflation was a bigger danger at this point. Would you say that's your view now?
It would be my view now. I think with an understanding that what may have happened in the first couple quarters on the labor side, which I think concerned several people were on the committee, and me included. But I think this PPI was interesting. That print was interesting. But I really believe that when we talk to a lot of folks in our district, is that if you had to kind of lean or have a bias toward, it would be on the inflation side.
Inflation still seems to be the problem. And we're hearing it time and time again from Fed speakers going into Jackson Hole. How does Powell deal with that narrative that actually the symmetric setup that the Fed has to deal with right now may be more biased in that direction, despite the fact there are signs in the labour market that things are getting a little more unruly than they have been in the past? But we don't know yet. There's so much ambiguity, particularly on the labour market side, that it's such a difficult call. And the market's got so certain that a September cut is going to be delivered. But the data's not there yet.
Right, and the commentary, such as we just heard, seems to focus more on the inflation side and very overtly saying there's more of a concern about inflation. On the other subject, around Fed independence, well, it's a very linked subject around Fed independence. I thought that was quite wonderful language from Schmidt, not picking a fight at all, trying to find a way through with language that avoids sort of fighting, even though he's not saying what the Fed, what Trump wants him to say, is he? He's saying he's more worried about inflation, and that's not going to lead to rate cuts. But he's saying, look, independence works, but I'm always open to a conversation about how we make it work better, which is a nice frame of words to try and take the heat out of this, perhaps.
But the market is clearly, and you can see this at the long end, beginning to get nervous about that independence. And if it continues to get more, you're going to end up with a situation where long ends have to price more and more of this in. There is this discount that has to be applied to the United States because of the fight that is happening within government between the White House and the Fed. And it feels only that is going to intensify.
Yes, absolutely. And this is something that Mark Cudmore has been talking about this week. So let's get to him now. Our Markets Live executive editor, Mark Cudmore, for 3 minutes on the markets. Your latest thoughts then ahead of Jackson Hole, Mark. Earlier this week, you were very preoccupied by the political pressure being applied to the Fed and what that will, either in the short term or longer term, do to the long end of the curve.
Absolutely. I think the really important thing to remember that going into Jackson Hole this weekend, it's clearly going to be market moving today. There seems to be a complete divide in the market, whether it'll be hawkish or dovish. For what it's worth, and not very much, I think he's going to be hawkish relative to expectations because, of course, there is no economic justification for a rate cut just yet. And he's probably going to have to point that out, particularly the topic on the labour markets. But that's not worth very much. The much bigger point is that Jackson Hole, Powell's speech is going to really matter in the short term, today, probably into next week. It's not going to change where we're going to be in a few months' time. And that is US assets are going to continue to suffer. Monetary policy in the US has been completely undermined. Doesn't matter what happens this weekend. It's been undermined. We know the fiscal situation is problematic and got worse. We know institutional credibility has been undermined. We know that the cost of doing business with the US is both more expensive and more uncertain and more problematic. It is going to continue to be a world of US underperformance. We've seen US stocks lose a decrease in their share of global market cap this year. That will be an ongoing theme. It'll likely accelerate into the end of the year. It's been accelerated a little bit in August, only slightly, but it's likely to continue. And linked to that, we're likely to see the dollar to continue to decline. So it's just a matter of when do you play the next big dollar down leg, not if.
Mark, US assets have outperformed over the last 3 months while all of this has been going on. Why?
Sorry, US assets have not outperformed over the last 3 months.
They've outperformed European equities. OK, I'm being simplistic about this. US equity markets have come roaring back over the last 3 months. Are you judging them both in
local currency terms?
To a certain extent,
you're forgetting about the currency, but
No, I'm not. If I put it all in euros, I've got the S&P up by 6% and I've got the Euro Stoxx 50 up by less than 1% in euros over the last 3 months.
OK, I tell you, you've picked two arbitrary benchmarks there, and they're important benchmarks.
Sure.
Now, a better way to look at it is the overall picture of the region versus each other. Now, I don't have the chart in front of me, but I'm pretty sure that the US share of global market cap has declined from 3 months ago. Now, specifically versus European stocks, I don't have the chart in front of me. The point is it's underperforming global stocks. It is below 48%. It was above 50% 6 months ago. 8 months ago, all those months. I'm not picking between both 6 months and 8 months ago. US share of global market stocks is declining. Now, if you want to tell me that in the last 3 months that the outperformance has been more about in Asia, absolutely. I think the much better story is in Asia. I fully believe that. I don't think it's just a choice between US and Europe. I think that Europe is the obvious liquid one for people who want to diversify from the US and don't really care about global affairs. But Asia is the much, much better story. Absolutely. The point is US shares are underperforming globally. When do you pick Europe? When do you pick Asia? For me, it's Asia.
Well, you're absolutely right. Asia has massively outperformed, and Asia has been the star over the last 3 months. Adjusted for currencies, I put it all into the euro. The CSI 300 up by 9%. You've got the Nikkei up by nearly 9% as well, smashing what we've seen in the United States and smashing definitely what we've seen in Europe. So, yeah, that has been where the outperformance has come. And maybe we in different parts of the world see things slightly differently. You from an Asia point of view, me from a European point of view. Mark, great stuff. Thank you very much indeed. Mark Cudmore, MLIV Go is the function on your Bloomberg, and you can get some fantastic coverage on that. Let's talk about some of the single stocks we are going to be watching into today's session. Chips front and centre. Chloe's here with the details.
Good morning, guys. So let's start and keep an eye on European semiconductor companies this morning after reports that Nvidia told some of its key suppliers to halt production related to H20 chips, which of course comes after China urged local companies to stop using those particular chips. So let's keep an eye on companies that supply to Nvidia, so companies like Siltronic or BE Semiconductor, which, as we can see, have already been having a bit of a tough year already. Bloomberg Intelligence said that this really adds fresh uncertainty uncertainty to Nvidia's China business, which of course has consequences for those key suppliers. Moving on to Poland, where we might see a bit of weakness in the banking sector. That is after the government announced fresh taxes on banks. So the taxes are going to go from 19% currently to 30%, and that is to plug a fiscal deficit, which is currently the second widest in the EU. So there's definitely a sense of urgency there. So we could see some weakness across those banks, which have been actually having quite a good year so far. PKO Bank in particular is up more than 60%. So let's keep an eye on that this morning. And finally, let's have a look at wind stocks. The Trump administration opened a probe into imported wind turbines and parts, and that could open the door to more tariffs. So let's keep an eye on Vestas and Nordex, which have been doing really well. Nordex is up more than 90% year to date, but obviously news of tariffs could dent that performance a little bit.
Chloe, thank you very much. Our equities reporter, Chloe Melly. And as Chloe was going to talk about wind stocks, Guy, I was just digging out the Vestas share price, remembering the big fall we saw linked to the election of Donald Trump, of course. And then, of course, the bounce just Monday, wasn't it? We saw a big bounce in Vestas share price as a result of some better news. So, I mean, the volatility around this sector is absolutely incredible. But we're basically back to where we were around the time of the election on that one.
Yeah, so the stock went up because of some big orders that were made in the United States. The numbers were actually fairly good. The outlook was confirmed going into the back half of the year, which poses challenges for Henrik and the team in order to make those numbers. But Trump just doesn't like windmills. He made it very clear that he didn't favour them. He thinks they're ugly and they shouldn't be happening. And it does seem as if that's now very much part of the narrative in terms of how they're going to be restricted in the United States.
It's sort of shades of not liking windmills that we're debating now, and that seems to be in the driving seat when it comes to the share price. But let's keep an eye on Standard Chartered as well. They seem to have had some legal news that could play out well. Sudzuka could be in focus as well on the back of, well, it's basically an earnings story there. So we'll continue to watch those businesses. Coming up, we'll bring you the opening trade. Futures expectations are fairly muted. We're all waiting for Jackson Hole, folks. So that's coming up later today. But we'll have the market open in the meantime. This is Bloomberg.
Friday the 22nd, the day we've all been waiting for. Powell is going to speak in, let's call it circa 7 hours' time. There's a great little bug that we've got. The open's 1 minute 43 away. We've also got another bug, which is fantastic, which is the countdown to the Powell speech as well. That little, I'm pointing the wrong way. The little bug down there in the corner. You're going to want to pay attention to that today because we're all on tenterhooks. This was the story yesterday. As you can see, a rally into the close for Europe, which the US then faded, which we've now got to price into our open this morning. This is what futures are telling us. It is a fairly mixed picture, mildly negative, but not by much. Stocks 50 futures are down by 0.2%. FTSE 100 is barely budging. DAX is down by 0.2%. There are actually some single stocks that are probably worth paying attention to. And Anna has got all of those.
Yes, absolutely. Let's dive into a couple of sectors that could be in focus today. And one of them is anything chip related. And actually, this is interesting and it's gaining in interest for me, actually, because NASDAQ futures are now down by 0.3%, having been quite muted for much of the morning. But the information is carrying a story that says that Nvidia has asked its suppliers to stop work on H20 chips for China. And that could be because of all the pressure that the Chinese government has put on companies to not buy Nvidia chips. So what does that do to those who supply Nvidia and to the wider AI story? We'll watch the chip sector. Defense stocks in focus. Yesterday they rallied, and this was on the back of the, sadly, we're pricing out expectations of peace in Ukraine anytime soon, given we're hearing from Lavrov of Russia, words about collective security, which according to European officials are designed to stall the conversation. So that's the latest there. Vestas in focus, as we were just discussing with Chloe Melly, because of the latest twists and turns and how much the Trump administration likes or does not like wind turbines, Guy.
Twists and turns appears to be the appropriate language to use when it comes to wind turbines. OK, here we go. Friday session. It's going to be reasonably calm, I suspect, in Europe. We're waiting for the Powell speech a little bit later on. We are now into the open. The opening trade is upon us. And as you can see, it is a quiet one. It was a quiet one yesterday. We're in mid-August here, folks. As probably, as you are well aware, that does tend to lead to quiet markets. But I wonder whether we're going to get some volatility later. Volatility's been really suppressed of late, though it has come up this week. Look at the VIX. We've gone from 14 to 16 this week. So just incrementally beginning to tick higher. Not by by much, not a big spike, not a scary spike, but just pay attention to that. Stock 600 barely budging, FTSE 100 actually down by 0.2%, which is interesting considering the expectation for a more muted open, but we're dealing with sort of splitting hairs here. The CAC's down by 0.2%, the IBEX is down by 0.2%. We'll see what the DAX does this morning. There's a few defence stocks that might be kind of in focus there, so keep an eye on them. We'll wait and we'll watch and we'll see what the DAX does in just a moment. Anna, sectors, single stocks, what do we got?
Yeah, let's go into the sectors because we set this up with a reference to Nvidia and that story and whether we see weakness in the technology sector. As ever, it's tricky to always find that directly in Europe, but we do see it. So technology is the worst performing sector today. So that Nvidia story, Nasdaq futures down 0.3%, does seem to be having a negative impact on stocks. And so, as I say, that sector is weaker. SAP down, but we're not talking about by much, down by 0.4%. ASML down by 0.7%. So there is weakness in technology, but not to a huge degree. To the upside, we see energy stocks up by 0.4%. We see a slight bounce in the oil price. 67.86 is the Brent price right now, and some of the oil names are a little stronger, but again, very little moving more than 1%. So we're not talking about big moves here. On balance, Guy, things look negative. We've got 3/4 of sectors, would we say, in negative territory, around a quarter, or maybe a third in positive. But the balance of things is negative as we wait for Jackson Hole.
ASML is down. So that is certainly a factor that we are seeing in the market this morning. Polish banks seem to be down. I want to get back to that and figure out what is happening there. I just want to check there's no ex-dividends that I'm missing, or maybe there's another story that I'm missing.
Yes, Chloe was talking to us about some of that, wasn't she, about the latest on the Polish banking sector.
But we've got Shell up. Standard Chartered is, as you say, up on some legal news. Total is trading higher. BP is up. So there's definitely an energy trend to the upside. But, yeah, it feels as if we are seeing a fairly quiet market this morning. You've got 225 up, 335 down.
Yes, this is summer, folks, and we are here for another week, perhaps. Salman Ahmed joins us, Global Head of Macro and Strategic Asset Allocation at Fidelity International. And I want to start with that, actually. It is summer. It is August. I remember last August, things got really choppy. That was to do with Japanese data and expectations around rates, but that went global because not everyone's at their desks, a lot of computers in charge, and volatility can happen in those kind of markets. And I wonder if there's a risk of that right now. We've got Jackson Hole today. We've got Nvidia earnings next week. Both of those could be big volatility events, couldn't they?
Yes, and they have certainly the potential to be, in the sense, as you're right. I mean, last year on August, we did get some wobble, which was corrected fairly quickly. But of course, I think in terms of what happens over the next few months, I think the Jackson Hole speech today, especially the September FOMC meeting coming through in mid-September, I think it's a quite an important event. And volumes are down, and as you said, market liquidity can be thin, so you can get oversized reactions. But those two events are the known unknowns at the moment.
Yeah, and how are you thinking about Jackson Hole then, Salman? I mean, weigh in. We've had every view imaginable. Some people suggesting, the markets, are right to think that we'll get some clues around a rate cut. Others saying, no, we'll get something more hawkish, and some saying he'll try to not poke the bear, in the views of one guest, and not try and trigger any political backlash and try to keep a low profile.
Sure, I think we have been in the camp of that Fed will only cut once in December, and this has been our view for many, many months now. And we are still think that this is a live meeting, so it's a 50-50 meeting. And they are, I think, if you take a step back, there are three dimensions I think we have to be thinking about, not only for September but onwards as well. Firstly, with this hyper data dependent Fed, we'll take a step back and start thinking about forward-looking indicators when it comes to tariff impact on inflation, for example. Second step is this inflation shock one-off, or it's going to be, more persistent? And I think that depends on, as Chair Powell has already said, on how the Fed may respond to it. So those are the two traditional factors, and then there is the unspoken politics, elephant in the room. And I think that's also important because the institutional signaling has to be passed, and I think that's not an event. That is a trend, and I think the first signs of that are potentially going to come through, hopefully, today.
Do you hedge the downside in stocks, given all of that?
So technically, there has been some a little bit down. We've seen some profit taking, I would say, in U.S. equities. They've done really, really well over the last few months. I think the epicenter of this is the bond market and dollar. I think that's where you have to focus.
But if the bond market freaks out, particularly the long end, how vulnerable are tech stocks and, by extension, US equity markets? And do I want to be buying volatility? The VIX is only at 16 at this point. insurance is cheap still on the downside. Is that something? Do I want to be thinking about protecting my downside after such a strong run as you say?
So I think we have been focused more on the credit market. We think because from a cross-asset perspective, that is the market which is the most expensive. If you look at, for example, if you believe in the growth slowdown story, then credit market spreads are too tight. If you believe in a stagflationary kind of a tension, again, credit market is exposed. And then if you think, okay, the monetary policy setup is changing, fiscal, macro volatility, so you're not getting paid in that segment of the market, and that's where we are focused on rather than the equity. I think equity is probably going to get affected if things get really bad.
How mispriced is credit then?
Sorry?
How mispriced is credit then?
I think it's probably the most mispriced one. Spreads are at all-time tight levels.
Sure. So but they keep getting tighter.
Exactly, keep grinding tighter. So if you have a choice from an asset allocation perspective, I think we are leaning more towards that, okay, you may still get upside and you have a pro-risk view, play it through equities, don't play it through credit. You're not getting paid.
And is the tariff story going to hurt provide more weakness for some of the credit names? Is that going to be the straw that breaks that camel's back or moves us away from those record tights then, Salman? Because you point out that the effective tariff rate is now closer to 19% than the 15% that people were sort of talking about when we had more positive expectations, I suppose.
Definitely, and it's creeping higher. So, of course, we're not expecting, this will double now, because obviously tariff rates are less than 3% going into this change in economic policies. It has increased multiple times over. But the intake of revenues right now is running at around 10%. So that is what the system is taking in. But that would gradually go up as the scope of these tariffs continues to widen. So the main, I think, complication in terms of the macro signal which is coming in right now, and I think it has linkages with the monetary policy developments as well, and depending on which side of the narrative Chair Powell comes through today, is that inventories have gone up as well. So that they are mixing the picture in the sense like how much front running happened and how much confusion they are creating into the real impact of that. So we are in that camp, and we remain in the camp that stagflationary tension in the U.S. will continue, and that's related to the credit view, but also the fact that we think this is a Fed which will be on hold because that inflation is in the pipeline.
Yeah. Have companies dealt with the imposition of tariffs better than you would have anticipated, Salman, then? Because I suppose that's the inventory story, isn't it? It's the ability of businesses to front-run the tariffs by bringing in a lot of inventory, to find additional suppliers, and that maybe limits the extent to which we see this in inflation, or at least delays it.
I think we are in the second camp, which is delay camp. So because you can't, there is front running, we saw in the data, but it comes with a lag. So the economic side of supply factors is very patchy. We are a demand-driven system. So we have very good data on demand, very bad data on supply, and inventory is a very good example of that. It comes with a lag. You can't tell how much has been used, how much has been run down till it's too late. If you from that like inflationary impact perspective. So we think that the pass-through will start to move towards 50%, but that may take a few months. Remember, there's only 2 months till the 10% collection rate was breached. So it hasn't been this is not a financial crisis, right? This is an economic policy shift, so it will take time. So we are in that delayed response camp rather than that this is not going to happen.
What's your view on the dollar right now?
So we have and remain in the camp that dollar is in a multi-year downward trend. Tactically speaking, even if the Fed is on hold for interest rate differentials to favor the dollar, other things have to start changing, right? There is you have the medium-term fiscal picture. You have the economic.
How does that impact my investment strategy? If I'm looking, does it undermine the case of the United States? And to what extent? If I'm getting 10% returns out of the United States, but I'm getting a lot of that eaten up by dollar depreciation as a non-US investor, do I need to look elsewhere, or is the US still the best place to be?
So I think we are pushing for diversification, and a lot of our clients and investors are looking to build in diversification from a strategic asset allocation perspective. Remember that strategic asset allocation shifts are big shifts, but they take time to come through. And we have seen a lot of strategic asset allocation reviews being done this year. Usually they're done once every 3 years. This year there's a higher frequency of strategic asset allocation reviews, especially from Asia. which are coming out, which tells us that, and there's a lot of discussion on FX hedging, there's a lot of discussion on, what should be your optimal hedging ratio, benchmark design. So I think this work will start to translate into big shifts, but they will happen over a longer period of time rather than, it's not like a one-day story in that sense.
Okay. Salman, nice to see you. Thanks for stopping by to see us. Salman Ahmed, Global Head of Macro and Strategic Asset Allocation, joining us from Fidelity. Core 6 looks like this. This is what we're watching across Europe. Tech stocks firmly in focus. As you can see, defence stocks coming back, continuing to come back. ASML is a little bit softer this morning, as is Schneider. A little bit of weakness in luxury, but not very much. Elsewhere, the action appears to be in that Nvidia trade. So let's get some more details on that with Chloe.
Good morning. So, let's start with a little bit of weakness. Oh, actually, it just turned back to the green here for Siltronic, but there was a little bit of weakness at the open for those two, which are suppliers to Nvidia. And Nvidia told some of its suppliers to halt production related to H20 chips after a China directive to stop using those particular chips. And we have a little bit of weakness for BE Semi, but Siltronic is actually going up a little bit. Those are not major moves in any case. Moving on to Polish banks. Polish banks are down by quite a bit, and that is of the back of news about new taxes. So their taxes are going to go up from 19% to 30% from next year as the Polish government tries to plug a massive fiscal deficit. So they're taking quite a beating across the board. We are down 7% kind of across those three major Polish banks. Moving on to the defense sector, where we've got a bit more of a positive story from Rank and Hensoldt. Both of those companies got upgraded to a neutral rating by Citi analysts. Citi analysts said that those two will really benefit from a rise in defense spending in Germany in particular. So we are up, particularly for Hensoldt, up 3.7%. And finally, let's end with AkzoNobel, which is a paint maker, a Dutch paint maker. And Cevian Capital took a stake in the company and said that there was significant value potential for that company. And so we are up on the back of that 4.3% this morning.
Chloe, thank you very much. Chloe Melly from our equities team with the latest on those stocks. Yeah, really interesting, that story around AkzoNobel and chemicals, the best performing sector at some part this morning in the early hours of this morning, Guy, as we watch Cevian take a stake there. And, do you interpret that as a vote of confidence in the management team's strategy, or are they after some change?
I interpret that as paint's going to get more expensive. It's already quite expensive. Looks like it's going to get even more expensive. When stocks have actually moved this morning, which I think is interesting as well, Vestas is coming back a little bit. It's certainly off its low. So it gapped lower first thing this morning and has come back a bit. Still down by 1.1% on the back of Trump's ire directed towards windmills, which is now starting to show up in terms of trade policy. Yeah, it does seem to be, though, every couple of weeks we get new stories that reset our expectations about how much he doesn't like them versus our earlier expectations. And so there's a lot of volatility in this sector, isn't there? We've been talking about Nvidia all morning. We will continue to do so. Nvidia reportedly halting production of its H20 chips, asking its suppliers to do so. We'll get the details next. This is Bloomberg. Friday the 22nd, 8:17, 17 minutes into the equity market session, and you are looking at a very becalmed market. We are going nowhere in a hurry. We are waiting for Jay Powell a little bit later on. He is the main event of the day. You could see some volatility around tech stocks, though, in the United States a little bit later on. We're seeing a little bit of that this morning, and this is very much focused on what we are seeing in terms of the Nvidia story that we've been bringing to you. Apparently, the company has reportedly instructed suppliers, including Samsung and Amkor, to halt production of its H20 AI chip. This is the chip that's designed for China. Tech publication, The Information, says this comes after Beijing advised companies to steer clear of the chip on security concerns. Robert Lee, senior analyst at Bloomberg Intelligence, joins us now. Robert, good morning. Is this about security concerns? Is this about something else? What are we learning?
Okay, well, thanks for having me on. So according to the story that broke about a week ago, the one you mentioned in your prelude, that Chinese government, unconfirmed I should say, was encouraging local AI companies to procure their suppliers their supplies from companies like Huawei on national security concerns. As to how grounded those claims were or not, we'll have to wait and see. But I think let's just take a step back from the news and the headlines at the moment. It's very clear that one of China's strategic objectives is to secure self-sufficiency on the technology front for all sorts of reasons. I suppose, to state the obvious, China and the US are major geopolitical rivals. I think from a Chinese perspective, the US has also proved itself to be an unreliable partner. So I think those are two of the reasons why China will continue and double down efforts to become self-sufficient in tech. And just an additional reason, obviously, as the government looks to rebalance the economy away from previous years where the economy was very much driven by fixed asset investment, high tech is seen as a major driver of future economic growth, so-called new productive forces. So again, that's another reason that underpins China's strategic move to becoming self-sufficient in tech. And these sort of headlines really, I think, will again cause the Chinese authorities to, if anything, increase or double down their efforts to achieve that.
Yeah, so we'll see what it is exactly that Nvidia has been saying to its suppliers about production of H20 then, with all of that in mind and that Chinese logic. In terms of what Jensen Huang's been saying, he keeps pushing back against any Chinese perception that there are backdoors in the chips or location functionality in the chips that they're supplying, the H20 chips. What do you make of his comments then, Robert?
Oh, far be it from me to contradict Jensen Huang, but I think it's always incredibly difficult from an engineering perspective to prove these claims either way, because don't forget that these chips are fabricated at literally the atomic scale. So whilst we can use very powerful electron microscopes to look at their physical, how they're physically put together, it's very hard to make a hard and fast conclusion based on the physical structure as to whether there are any so-called backdoors. But similarly, software or the middleware, another software, operating software that is operating on these chips, it's very hard to get access to the source code to prove or disprove such claims. But I think, again, what is underlying this is the heightened geopolitical rivalry between China and the US. China will almost certainly double down efforts to achieve self-sufficiency. It obviously wants to fully support its emerging national champion, Huawei, which on a global scale is the main local rival to Nvidia. So obviously that helps support Huawei's business domestically and helps reduce that reliance on US components. So very briefly, that begs the question, looking forward, even if we look forward 6 months, 12 months or beyond, how will this story evolve? China is obviously still reliant on American components, whether it's Intel chips, whether it is Qualcomm chips, whether it is American software. If this story continues to evolve in the coming years, we could see, further moves by the Chinese authority to push and champion local suppliers at the potential cost to American companies.
Do the Chinese suppliers have the software stack and the infrastructure that goes around the chips in order to be able to compete? Is that where the real gap actually ultimately lies, and that's where the Nvidia advantage sits?
Okay, I think in terms of third-party benchmarking services that have tried to compare the performance of Nvidia's chips, I think it's still, nobody would disagree, even in this part of the world, that the American technology is superior. But again, with the full weight of the state behind them and, with obviously a very strong engineering base who is rapidly going up the skills curve, China is progressively narrowing the gap. More so on the software side of AI, but progressively on semiconductors as well. The big issue or stumbling block that they face is really access to high-end lithography equipment, which, as you appreciate, is dominated by the likes of ASML. ASML is the only company globally with EUV equipment that can produce very advanced leading-edge chips. So obviously there is a strategic imperative for the Chinese government and Chinese authority to try and drive a technological breakthrough. As to whether that will be achieved or over what timescale remains to be seen. It could take years, but again, it is of national strategic importance, and I think with a very strong engineering base, ultimately the Chinese will do it. It's just a question of exactly when that happens.
Okay. Robert, thank you very much. Robert Lee, Senior Analyst at Bloomberg Intelligence. Thank you for the update on Nvidia and tech. Now, after decades of cautious saving, Germans are finally embracing the stock market, we understand. A booming market has spurred a significant shift. 3 million Germans have started to invest in stocks since 2022, the largest increase in stock ownership in Europe outside of Britain. For more, let's talk to Bloomberg's Sagarika Jaisingani, who's Deputy Team Leader for EMEA Equities and Investment Strategy. Sagarika, great to have you with us. So Germany hasn't typically been known for a big retail investment community. So what have we learned here?
Sure thing, Anna. You're absolutely right. When you talk about the countries in Europe, across the world, that are most famous for retail participation, Germany doesn't really feature highly on that list. Having said that, though, I mean, there's reasons for that, right? You said that the psychological scars that were the result of the hyperinflation era, and more recently, relatively speaking, the tech bubble as well, because the data that we have shows that the number of retail investors in Germany just before the tech bubble was actually on the rise. It was quite significant.
Are you talking about, you're talking about 2000?
Yes.
Right, okay, we're going back away.
Yes, and not 2022, not that was a bubble. But after that, the proportion of investors really fell off. So they got quite burned in that one. And it's taken a long time for that mindset to now shift out of that. What is finally driving them back into the market now? That's the answer to that is twofold. One is the German stock market has been very hot. Not just this year. This year, of course, it is outperforming the S&P 500, tracking 20% plus gains. But it has had a similar scale of performance over the last 2 years as well. So it's becoming more of a buzzword among younger investors who are more open to this. There's a very significant worry also, which is the second part of this, which is what is the pension outlook looking like? The current system in Germany is a pay-as-you-go system for pensions, which is that the current workforce is funding essentially pensions for current retirees. So as the population ages, what happens to that? So there's the people that we spoke to for this, there's significant questions on, is that even sustainable? So there's two factors at play here.
Just quickly, how fast is this evolving? That all sounds very sensible. In the United States, we're kind of getting the gamification effectively of the markets. Is there any evidence of that happening in Germany? Is this becoming entertainment in the way that maybe we're seeing over in the United States, or is this kind of quite Germanic and quite sensible, and this is the right thing to do?
Oh, there's definitely both of that, because if you look at the avenues that are being used to advertise to mom and pop investors, it's across the board. There has been social media is the go-to in today's world. So there's been a crop of financial influencers, finfluencers as they call themselves. Again, they're common in the US. This is not a conversation we were having in Germany, a couple of years ago. They are everywhere now. There is, we spoke to, one of the people we spoke to, he's an 82-year-old finfluencer substyle. He is a former broker and a trader, so he's definitely a finance professional. He said, I've spent 50 years trying to get Germans to invest in stocks, and what I heard was, it's like a casino, it's only for the rich. Some said it was like a highway robbery. That is now changing because of all of this education and information that's out there.
I can be doing this for a while, yes. Keep going. Sagarika, thank you very much indeed. Sagarika Jaisingani joining us on the markets. Up next, we're going to talk trade. That's next. This is Bloomberg.
This is the opening trade. 30 minutes into today's session. Let's take stock of where we are then on Friday's session. We see some weakness, a little bit of weakness across European equity markets, but not much. We're waiting for the Jackson Hole address later from Chair Powell. So that's going to be the big thing in markets to watch out for. In the meantime, though, we do see a bit of weakness and technology to the fore. NASDAQ futures are weaker. That all has to do with what Nvidia has been saying to its suppliers about the H20 chip into China. Interesting reporting from elsewhere on that, and that's taken the edge off NASDAQ futures, also taking the edge off European tech stocks. We watch that. On the other side, though, some chemicals positivity coming through in the shape of AkzoNobel, which has attracted some interest from Sevian Capital. So we keep that in focus. So we're kind of flat, not doing much, Guy, as we wait for Jackson Hole.
If you want a snapshot of an August market, I'm going to give you one. Here you go. Stock 600, higher, 275, lower, 297. I guess we're going to call that fairly finely balanced. Take a look at the volume. We're down by nearly half. We are seeing a light volume day. I do wonder, remember, Powell speaks at 3 p.m. London time. The markets in Europe have still got an hour and a bit in which to trade. I do wonder where the volatility potentially has picks up later on in the day. We get a quiet kind of morning, early afternoon, and then things start to move. There's an interesting 52-week high out there. That's 52-week low, sorry, actually. Taylor Wimpey. This is the 1 year on Taylor Wimpey. This is the UK house builder. Look at it, tracking lower and lower and lower. There's a bunch of factors here that are coming in. One of which is what is happening with the regulatory backdrop in terms of what is happening with housing in the UK. That's one factor. Just trying to get houses built is hard, and we don't see much easing of that, despite what the Labour government is saying. You've also got the rate environment, which is worth paying attention to as well. House building is slowing down, it seems, not speeding up, much to the annoyance of the government. And we're going to get Bailey speaking. The data in the UK at the moment speaks to maybe steady rates, not lower rates, not significantly lower rates, and that's being priced into these kinds of stocks. And as you can see, Taylor Wimpey down by nearly 40% this year. That stock certainly being punished, and today another 52-week low, Anna.
Guy, let's get an update on some of the other stories that we need to know about this morning. The Justice Department in the United States has signalled possible plans to investigate Federal Reserve Governor Lisa Cook, with a top official informing Fed Chair Powell of the probe and encouraging him to remove Cook from the board. Cook on Wednesday said she intended to remain at the central bank after Trump called for her resignation. Nvidia has reportedly instructed suppliers, including Samsung and Amkor, to halt production of its H20 AI chip. Tech publication The Information says this comes after Beijing advised companies to steer clear over security concerns for the chip, especially built for the Chinese market. Nvidia, for its part, has repeatedly denied it adds backdoors into its chips. Now, the US and the EU have outlined trade plans that could reduce tariffs on European cars to 15% within weeks and potentially offer discounts on steel and aluminium. European Commission President Ursula von der Leyen says the deal provides predictability and stability for companies and consumers and strengthens transatlantic relations, though, Guy, crucially, there are still hurdles to overcome to achieve those lower tariff rates.
Many, many hurdles still to be ironed out. Can you iron out a hurdle? Wrinkles, maybe, I should be putting into that sentence. Maria Demertzis, Economy Strategy and Finance Centre Europe leader at the Conference Board, joining us on this subject. Maria, good morning. We thought we had a trade deal. We thought we'd be kind of dealing with the reality of that now, but we feel that we are still a long way away from it. What is going on? Why is it taking so long to get this trade deal between Europe and the United States to actually work and deliver?
Well, trade deals are notoriously difficult to agree in the best of circumstances. They are anything between 18 months and 5 years, and that is under normal circumstances. I don't think we have normal circumstances now, given that what's at stake is so high, and given that actually it's not just about a trade deal, it's all about geopolitics, much more than just about trade. So that's not surprising. Where we are now, we've got a little bit more clarity on the possibility of a deal. Again, we don't have a deal, we have a framework, meaning an agreement of how we are going to approach this. Some good news that came out of yesterday's announcements, the 15%, of course, which is better than 30%. And crucially, it will include some pharmaceuticals, semiconductors, and also some pharmaceuticals will be under the most favored nation clause, which is under WTO, which means effectively lower tariffs. So these are good news. Perhaps the most important, in my view, of these good news is that we have dodged the bullet of an outright trade war. I think this is crucial. There are big voices here in Brussels and in capitals that would have wanted a slightly different reaction from the EU, meaning an escalation. But we've managed to avoid this, and I think that's a success.
Have we managed to avoid this for now? How big is the risk of escalation still?
Yeah, I'm afraid you're right, in the sense that it really is just for now. And I think the most obvious example of this is in cars. Very little has been agreed on cars in terms of reducing the tariff rates. For the moment, cars are under the close to 30% tariff. They have not been included to this new 15% tariff rate. Not only that, but also what we understand from what was announced yesterday, the Europeans will need to go first in terms of removing tariffs on some industrial goods. and allowing easier access to agricultural products. For these things to happen in the way that the EU is governed, it will require capitals to agree on this, and well, possibly the European Parliament, which means that it will take a long time. All of this makes me believe that it will not happen in the short run. It won't happen in the medium run either, in my view. And that, of course, is important because the countries that have been pushing for greater trade deals, better trade deals with the US, have been those countries that produce cars. And I mean here, Germany. So if Germany doesn't get lower tariffs on cars, I think the mood might actually change. And that, of course, we're back to what can we do to escalate.
Maria, in terms of the process and how it is managed now in this new world, do you feel that we're in a kind of rolling situation of permanently in trade negotiations? I mean, do you think the new administration in the United States is minded to bring these things to conclusion, or does it suit their purposes to have this being an ongoing narrative?
Difficult to tell. I think on the one hand we have President Trump, who's always arguing for deals. On the other hand, you see that these things are not easy to achieve. I think the time scale that he had always been putting forward is unrealistic. Like I explained earlier, trade deals take a long time because there is a lot at stake. In the current situation where negotiations isn't just about trade, it's about dependencies on defense, it's about dependencies on energy. All of these things are so complicated, and the new administration in the US is really interested in extracting rents from all of this. On the other hand, the EU has very little cards in its hands simply because we depend on the US very much on semiconductors and primarily on defense. This is crucial for the EU, and it will be a very difficult negotiation time in the next couple of years. So dare I say, the whole lifespan of the administration for the EU.
Take us into one sector that I know has got a lot of attention, perhaps because it always attracts outside attention. That's the drinks sector. The Europeans failing to achieve any kind of carve-out or special treatment for wines and champagne. I mean, how should we view this kind of conversation? Are the Americans going to be facing pressure from consumers to bring things in more cheaply, or is everybody in the States going to be fairly happy with just replacing with domestic production?
Well, I mean, I think, if your question is about the inflationary impact in the US, yes, we are going to see it. We already see it in import prices in the US, and this is only going to deteriorate. And actually, some of the numbers in terms of consumer confidence, but also expectations, are telling us this. There will be an impact on prices in the US, and that, of course, will mean two things. The US consumer will start substituting. They will have to substitute, but that means that they have less choice. That's why we say that actually tariffs is not a good thing for the consumer, because it reduces choice. So it will be the choice for European goods or for general goods in the consumption basket, and it will be much more expensive for that. Now, when it comes to the particular product, from the point of view of the EU, I think the EU is now taking the position that we need to discuss economic value. So what is the products that represent the highest economic value? And next to that, and in my view more importantly, what is the most important goods when it comes to economic security? And that is why semiconductors are really the ones that matter the most for the negotiation process, rather than other goods like wine or agriculture. I think this is absolutely crucial. And of course, remember, next to that, we need to buy more defense from the US, and we need to rely on the US for security guarantees when it comes to Ukraine. That reduces the space that the EU has to negotiate anything.
Maria, is this a permanent situation that may even outlast the Trump administration? How long-term is the current environment going to exist for? Have trade deals, as you say, trade deals take a long time to do. If you were to change the administration in Washington, completely change the strategy right now, how long would it take to put things back to where they were before? Do you think things are ever going back to where they were before?
It's difficult to think of going back. These are one-way streets, typically. I think the issue of who is the ally here is crucial, and that may possibly change with a change of tone coming from the US. For the moment, it doesn't feel like we are allies with the EU, the UK, and the US. We don't feel like we are allies. It feels much more like a negotiation about extracting rents, and of course, at the expense of Ukraine, because this is really what needs to be resolved as quickly as possible. So, in the current administration, I don't think much will change. But in the next administration, I think in the possibility of realizing that we need allies, everybody needs allies, and that includes the US. That may change. It could change quite fast. But I don't think we can really realistically say of going back to what. These are one-way streets, and we will go somewhere else. We will find better ways of being friends, and some things will resolve and some we won't.
But a new reality is now with us and is unlikely to change. Maria, great to catch up. Thank you very much indeed. Maria Demertzis, Economy, Strategy and Finance Centre Europe leader at the Conference Board. Coming up, will Jerome Powell signal September rate cuts in his speech at Jackson Hole today? Expectations are maybe moving away from that. We're going to look forward to what we can hear and what we should expect. That's next. This is Bloomberg.
Where you saw services inflation, which is probably not driven by the tariffs, really start shooting up, is a danger. That's a dangerous data point. I'm hoping that that's a bit of a blip. So I think we still have a fair bit of information that we're going to get before September or the whole fall to determine what path we're going to be on.
Somebody waiting for the data then, at least partially. Chicago Fed President Austin Goolsbee there, speaking from Jackson Hole ahead of Chair Powell's speech. Let's get an update from Valerie Teitel on what she's thinking ahead of Jackson Hole. And we're all waiting hours until 3 o'clock UK time, I think, Val.
Yeah, that's right. I am holding my breath until Jerome Powell's speech is released. But I think those Goolsbee comments we just heard really put into good perspective what we've heard from Fed officials over the last 24 hours. No one out there claiming that the September rate cut is a done deal. Many of them saying that they still want to see more evidence in the data before they make that kind of decision. That compared with some that as well with some hot data we got yesterday, the PMIs coming in strong, led to a slight repricing in the front end. We did see yields shoot up in the two-year yield. And ever since that hot PPI print now, these two-year yields have drifted higher, around 10 basis points higher since last Thursday. And that's led to the pricing for this September rate decision to start edging down. It was over 100% last week. It's now ticked all the way down to 75% before before we hear from Fed Chair Powell later today. It's also given the equity market a bit of a struggle. This rise in front-end yields and that tech rout has led to the S&P 500 to underperform, falling for 5 straight sessions, looking to make it 6, with S&P futures down over 1.5% in the last 6 sessions. But it all really comes down to today, where to next for this equity market and for the bond market. If he's going to be dovish, he's going to have to change his tune when it comes to the labor market. That is the big catalyst for a dovish surprise. On the hawkish side of things, Guy, we could be looking at maybe a quite technical speech where he removes some sort of monetary policy framework that was put in during COVID. And if he wants to sound neither and in some way say that there's still big questions ahead, he'll point to the more data we have before that September 17th decision. Remember, we still get another payroll report and another CPI before that decision.
Great stuff, Valerie. Valerie's going to be holding her breath until 3 p.m. today.
Sounds dangerous.
I'm going to watch that with interest to see what happens. Jackson Hole, what a place to hang out this weekend. If you don't have the luxury of hanging out in Jackson Hole this weekend, and I can think of fewer nicer places, there are other options available, I have to say. There's going to be some great tennis coming up. I think Alcaraz has got a really tough run through this morning. I think Djokovic as well is going to have a tough run too. So that's going to be interesting to watch. The Women's Rugby World Cup is on. Going to be paying attention to that. The Notting Hill Carnival. I generally avoid that part of London during this weekend, but I'm told it's fun.
It's great fun. Yeah, very loud, but great fun if you like that kind of thing. Great food. You were keen to point out which sport we were talking about, the US Open. I think it's self-explanatory. I think that looks like a tennis ball.
Yeah, I think US Open, I think golf, but anyway. But it does look like a tennis ball, I admit, moving quite swiftly. So, yeah, I like the graphic. Anna's going to be spending a great deal of attention focusing on what is happening at Reading. The lineup I hear is...
I'm not sure many of our viewers have Reading and Leeds Festival in mind for their weekends, but those with teenagers might be focused on what's happening over at Reading and Leeds.
Yeah, Anna's going to be paying a great deal of attention because she is definitely one of those. If you are not attending Jackson Hole or any of those fantastic events this weekend, you may be heading off on your annual summer holiday. We've also got a UK bank holiday coming up this weekend, and then you've got another holiday coming up in the United States next weekend. So this kind of feels like it's peak season for holidays. And there's plenty of choice out there, but where should you be going? Well, let's ask a few experts. Bloomberg Pursuit's luxury reporter Sarah Rappaport joins us now to talk about trends in travel. So I'm nervous about using the word hotspot, because hotspot has different connotations these days, particularly given what is happening around Europe at the moment. So let's kind of park hotspot. But if I was looking for a cool spot to go to, where would it be?
Lined it up perfectly, Guy. It's all about cool occasions now, because the weather in the Med is just so hot. We're seeing record temperatures in places like Greece and wildfires.
Yep.
The people are pushing their August holidays into September.
The shoulder months, I'm told.
Shoulder season, they're really the peak times now. Rates are rising. You can't get the kind of deals you used to be able to in September or even June. So in places like Antiparos and Paros, hotels are just as booked in September and June as in July and August. And people are picking places like Copenhagen or Stockholm or even Scotland to go to instead of the Med, which I know is wild, but...
Going wild in Scotland.
Wild indeed. You have one of the best jobs at Bloomberg, I think, Sarah, because you get to write about and experience luxury travel and all that goes with that. And for some people, this will be a dream, what I'm about to mention, and for others, this will be a nightmare. But luxury sleeper trains are making a resurgence.
It's like
Tell
the
us
Orient
more.
Express, isn't it?
I know.
This is what I think about.
Extremely
but is that the
glamorous.
reality?
I think they're wonderful, but they are a very high price point. And just for you, Guy, I found a fun fact. It's the 200th anniversary of the British rail system this year.
Okay.
And luxury sleeper trains are having a
really
resurgence.
improved since then.
Well, maybe not. But Belmont, what we're seeing now, has launched the Britannic Explorer. And it is the first luxury sleeper train in England and Wales. And it launches soon this month. £11,000 for 3-day journeys to Wales, Lake District, and Cornwall.
Wow.
So that does include food and drink and activities.
So you go to Cornwall, then you go to Wales, and then you go to the Lake
different
District.
journeys. Some go to Wales, some go to Lake District, some to Cornwall.
In 3 days.
You can pick 3 different destinations, And those are booking up with Americans excited to go on trips, mostly rich Americans, to be honest. But they're very popular with the people trying to go to the UK.
Okay, so sleeper trains and a return of cooler holidays and shoulder months for some of the hotter places. Those are some of the trends. We'll continue this conversation, but Sarah, thank you very much. Thank you. Sarah Rappaport. Let's widen the conversation now with Tom Cahalan, who's founder of luxury travel agents Dorsia Travel. Tom, thank you for joining us. So no doubt you recognise some of the trends that Sarah was just talking about there. But if you're thinking of new and exciting up-and-coming destinations that luxury travellers should think about and have on their radar, what comes to mind?
Oh, Hannah, have you considered the Reading and Leeds Music Festival this weekend? No, I'm kidding.
That sounds very luxurious.
Exactly. I love that being there. We're seeing very, very similar to what has just been said regarding. I always used to recommend May, September, great time for Europe. The rates have gone up so high now that September is peak season. The weather can still be very, very hot. So we're actually seeing a lot of people prepared to travel significant distances to places like Mozambique. Now, there it might not seem quite as normal as you might think, but you've got extremely high-end luxury properties there. You've got a lot of money going into conservation. So as a result of that, you've got new national parks are being restored to what they used to be. And value for money is very, very high in these places as well.
Okay.
And I think that's been seen generally across a lot of places, like the Indian Ocean. Other than the Seychelles, it's generally off-peak this time of year. You can risk the rainy season, but when you're comparing rates of getting, say, a 250 square metre villa in the Maldives in one of the best luxury resorts in the world versus a 30 square metre room in Saint-Tropez, to a lot of people, it can be very appealing to look elsewhere, look much further afield.
Is climate change, Tom, changing things? Is the over-tourism narrative changing things? How quickly are we seeing the tourism industry evolve around both of those two stories?
Yeah, that's an interesting question, because going back to the Maldives, traditionally, a lot of properties in May, they just shut. And some of them even go into June and July, and they're so low peak, you can be single-digit occupancy numbers. But now, actually, it can be quite a good time of year to go there. And some of that is because of climate change. But it works both ways. So, and just focusing on the Maldives for a moment, but traditionally peak time is end of December till April. This year, January was extremely wet. It rained a lot there. So it can work both ways in that you think you're going somewhere when it's peak, but the weather can be so sporadic, you don't quite know what you're getting. So I think generally you're... Sorry.
Well, I was going to say, and what is it that people are going for? Is it still luxury hotels, or is it about the sort of villas and the large homes and the big parties, taking your friends with you? What's the vibe these days, Tom?
It's all going to depend, but we are seeing a lot of multi-generational family bookings. And so the way that companies have responded to this since COVID is, I think initially from COVID, you had companies going, people are afraid of being around each other, let's build villas. But subsequently, COVID is not a point that comes up anymore, but people have realized that spending time with their friends and family and having these exclusive use large villas is an extremely appealing element of it. So you're going to have certain people, it's going to be just purely, it's a beautiful location. Some, because you get to take all your friends and family. And again, if you're comparing that to certain places, if you're comparing what you can get, even at peak in, say, the Maldives, where you can take an entire private island for less than you could take 2 or 3 entry-level rooms in certain parts of south of France or Italy, it starts to become a real... It's still not cheap, but it starts to look like value for money.
Yeah, everything's relative, particularly when you've got your relatives with you. Yeah. Tom, thank you very much indeed. Tom Cahalan, co-founder of Dorsia Travel. And what you should be maybe thinking about this weekend, if you're not, of course, going to the Reading Festival or the Central Bank Festival, which is in Jackson Hole.
Absolutely. I'm going to spend all weekend trying to focus on what's happening at Jackson Hole and monetary policy instead, Guy. Because, I mean, have we still got our countdown clock? That should be running.
Not many hours to go.
Not that many hours.
Val's still holding her breath.
Yes. We're checking on her at regular intervals to make sure she's okay. But yeah, not many hours to go, and so the big question remains: what kind of
is he a dove or
message?
Is he a hawk?
Yes, and does he try to be neither? Is it possible to be neither? Does he upset people? Does he upset the White House?
Maybe a moose. Plenty of moose there as well. Stay with us. Great coverage coming up from Jackson Hole, the Economic Symposium. We've got some interviews coming up, which you are definitely going to want to pay attention to. Some former Fed presidents, some great guests. Rich Claret, I think, has got some really interesting things to say around what is happening here. Also, Mr. Bullard, I think he's going to be worth listening to as well, considering he potentially could be on the list for the next Fed chair. Anyway, the big event, of course, is the Fed chair, Jerome Powell. He is speaking at 3 p.m. UK time. Everything's basically about the countdown into that, as a result of which that'll be the big focus on the Pulse next. It is coming up shortly. Have a great weekend, folks. This is Bloomberg.